Please like, share, and subscribe. Wishing you happiness and good luck every day.
Have you ever daydreamed about it? Being your own boss, calling the shots from a laptop, maybe on a beach somewhere, just navigating the wild currents of the stock market? Well, today we're diving headfirst into that dream and its pretty harsh reality by breaking down Toni Turner's classic, A Beginner's Guide to Day Trading Online. Let's jump right in. That quote really hits the nail on the head. It captures the two sides of this coin perfectly, the incredible highs and, the devastating lows. So let's start where everyone starts, with the dream. So what's the big pull? What is it that gets so many people glued to their screens, ready to take on one of the toughest games in the world? Well, it all kicks off with this really powerful vision of freedom and, of course, control. And for a lot of people, that roller coaster isn't a bug, it's the main feature. The adrenaline, the excitement, pitting your own wits against this massive global financial machine, that's a huge part of the appeal. It's a thrill. I mean, the lifestyle they sell you is the ultimate pitch, right? You answer to absolutely no one. You can work from your home office, a cafe, a beach in Bali, literally wherever you want. Your schedule is your own, and forget the suit and tie. Like the book says, you can trade in a torn t-shirt and duck slippers if you want to. Sound perfect, doesn't it? All right, now for the reality check. Because for every single one of those dreams of freedom, there is a nightmare of financial ruin just waiting under the surface. 80%. Let that sink in for a second. That's the percentage of people who try this and quit. Most of them after completely blowing up their accounts. And it's not just about losing money. It's the unbelievable psychological pressure of competing at this level that just grinds people down. This is not a game. It's a battlefield. This line from the book is, well, it's brutal, but it's dead on accurate. The road to becoming a successful trader is absolutely paved with the financial wrecks of people who just weren't ready for what the market is really like. You have to respect it. You have to understand this. The market does not care about you. It doesn't care about your hopes or your bills. It is an arena of pure survival of the fittest. The smartest, most disciplined, most well-funded minds in the entire world are on the other side of your trade, and their goal is to take your money. There is zero mercy. Okay. So if you're going to survive on this battlefield, you have to understand the basic forces at play. And honestly, it's not as complicated as it looks. At its very core, it's just a giant tug of war. So every single day, it's the bulls versus the bears. The bulls are the optimists. They're buying because they believe prices are going to go up. Just think of a bull thrusting its horns upwards. The bears, they're the pessimists. They're selling, betting that prices are going to fall. Think of a bear swiping its paws downwards. Your entire job as a trader is to figure out who's winning that fight right now and join their side. But what actually makes those prices move? Well, it all boils down to two simple words: supply and demand. And the book has this absolutely brilliant analogy to explain it. It all starts with a cookie jar. Think about it. When your mom says, no cookies, what's the one thing you want more than anything in the world? A cookie. When something's off limits, your desire for it, your demand, it just skyrockets. Okay, now picture this. You open that jar and, oh no, there's only one cookie left. And to make it worse, your brother sees it and wants it too. What happens? All of a sudden, that one cookie is the most valuable thing on the planet. Its limited supply has made it incredibly desirable. You'd probably trade your whole allowance for it, right? But the next day, your mom goes and bakes a giant platter of cookies. They're everywhere. Suddenly, they're not so special anymore. The supply is huge, so the demand and the price you're willing to pay plummets. And that simple little story, that is the engine that drives every single stock in every market every single day. Limited supply means higher prices. Abundant supply means lower prices. That's it. So you get the dream, you respect the danger, and you understand the basic forces of the market. Now what? You can't just walk onto the battlefield empty-handed. You need the right weapons. Because that's what it is, really. It's a battlefield of information. And if you go into battle, you better be armed. For any modern trader, your weapon is your information screen. Okay, I know this looks really intimidating, but this is what the pros see. It's called a level 2 screen. On the left side, you see the bid column. That's all the buyers and what they're willing to pay. On the right side, the ask column. That's all the sellers. This thing gives you a transparent, real-time look at supply and demand. It's basically your X-ray vision into the heart of the market. So, We've covered the dream, the danger, the theory, and the tools. But we've saved the most important part for last, and that part is you. Before you even think about clicking that buy button, you have to be mentally ready for this.
To even have a fighting chance, you have to live by these rules. First, treat this like a business, not a weekend hobby. That means you need a plan, you need discipline. Second, and this is huge, never trade with money you can't afford to lose. Scared money makes bad decisions, period. And third, never, ever stop learning. The second you think you've got it all figured out is the exact moment the market will humble you painfully.
See, at the end of the day, making money is just the result of doing everything else right. The real question isn't about your strategy or your tools, it's about your character. Can you handle the stress? Can you stay disciplined when you're losing? Can you stay humble when you're winning? Day trading is like a giant mirror that reflects every single one of your psychological flaws. So the final question isn't about the market at all. It's about you. Do you have what it takes? Have you ever had that dream? You know, the one. Ditching the 9 to 5, making a living from your laptop, maybe on a beach somewhere? Yeah, the world of day trading loves to promise that. But what does it really take? What's the truth behind the glamour? Well, that's what we're going to unpack, using Toni Turner's guide to separate that dream from the often brutal reality. I mean, come on, the appeal is huge, right? You're the one calling the shots. You decide when you work. Your commute could be a 10-second walk from your bed to your desk. It's that ultimate picture of freedom. And the dream goes even deeper. It really is a life you can build to order. You can forget about suits and ties. The source material literally talks about trading in torn t-shirts and duck slippers. Sounds perfect, doesn't it? Well, this is kind of where the good news stops. Yeah, because on the other side of that amazing dream is a very, very harsh reality. The market, it's not your friend. It's not a gentle place to learn. And as the old saying goes, Wall Street takes no prisoners. Just let that one sink in for a minute. The author and psychiatrist, Dr. Alexander Elder, he wasn't just being dramatic here. He was being dead honest. This isn't just about spreadsheets and numbers. It's a high-stakes psychological battlefield. This number tells a huge story. 80%. Nearly 8 out of 10 people who give day trading a shot, they quit. And they don't just walk away. They often get completely wiped out. They lose their trading accounts because they didn't know enough, they traded too much, or they just took really foolish risks. And here's a big reason why that failure rate is so high. You have to understand who you're up against. This isn't a friendly game. The stock market is a world of greed versus greed and fear versus fear. Every single day, you are going toe-to-toe with some of the sharpest, most disciplined minds on the entire planet, and their goal? It's to take your money. There's no mercy. Now, a lot of people make this one critical mistake right from the very beginning. They think trading is just investing on fast forward. It's not. Not even close. Toni Turner has this fantastic analogy. Comparing them is like comparing kangaroos to hamsters. Investors, they're the kangaroos, in it for the long haul, taking big leaps. But traders, we're the hamsters on a wheel, reacting to every little short-term move. It's a different mindset, different rules. A completely different game. So if the game is that ruthless and 80% of people fail, then who are the 20% that actually succeed? What do they have that others don't? Let's take a look at the DNA of a successful trader. You talk to any trader who's been in the trenches and they'll tell you it comes down to these 3 things. You need bucks, that's capital, real money you can actually afford to lose. You need brains, you have to understand how the market works. And you need boldness, the mental grit to actually pull the trigger when the pressure's on. And that list of traits gets even more specific. You have to be okay not knowing if you're going to land on a pile of feather pillows or in a pit of hot lava. You have to act fast and be decisive. You've got to be able to change your mind in a split second without your ego getting in the way. And above all, you need unshakable emotional discipline. And as Dr. Elder says here, this is so crucial to get. Your emotions are directly wired to your bank account. You could have the most amazing strategy on earth, but if you trade when you're scared or angry or feeling way too confident, you are going to lose money. Period. So, all of this brings us to the most important part of our whole discussion. It's time for a little reality check, a moment of real, honest-to-goodness self-reflection. You got to ask yourself if this is really for you. Okay, first things first, the money question. I'll tell you this. Every successful trader I know lost money when they were learning. It's the price of admission. So can you genuinely handle that?
Can you take a financial hit without it completely shattering your confidence and making you want to just give up? Next up, the mental test. There will be times you have a single second to make a decision worth thousands of dollars. There's no time to second guess, no one to ask for help. It's just you. Can you make that call calmly and clearly when everything's on the line? And finally, the gut check. After a huge win, can you stop yourself from getting arrogant and reckless? And after a painful loss, can you fight that urge to revenge trade? To dive back in out of pure frustration and dig yourself an even deeper hole? That discipline is everything. When it comes right down to it, trading is an all-or-nothing commitment. The roller coaster analogy is perfect. You're either on the ride, screaming your head off as it twists and turns, or you're standing safely on the ground, watching. You can't have one foot in both worlds. That's just a recipe for getting hurt. And that leaves us right here, with the core message of it all. This is real money, real pressure, and real consequences, starting from your very first trade. It is not practice. It is the live performance every single day. So the final question you really have to ask yourself is this: are you ready for opening night?
So when you hear Wall Street, what's the first thing that pops into your head? Probably a crazy mess of numbers, charts, and people yelling, right? But what if I told you it's less about math and way more like a jungle? Yeah, a jungle. A wild place with its own history, its own creatures, and its own laws of survival. In this explainer, we're basically going on a safari to figure out this financial wilderness.
Okay, so let's kick things off with a bit of a riddle. What in the world do cavemen, cookies, and a stampede of animals have in common? I know, this sounds like the beginning of a really weird joke. Well, believe it or not, they're actually the perfect keys to unlocking the biggest secrets of the stock market. Just hang with me here, because I promise by the time we're done, it's all going to click into place. To really get this, our story has to start way back, long before stocks or bonds even existed, with the very first traders. Just picture it. One guy's a great hunter, the other's a great fisherman. The moment they decided to trade some meat for some fish, bam! The basic idea of a market was born. Okay, now let's fast forward a couple thousand years. That street we all know today, it got its name from a literal wall that Dutch colonists built back in 1644. Funny enough, it was to keep their cows in and the British out. The wall is long gone, of course, but the name stuck. The real action kicked off in 1789 when the brand new U.S. government issued $80 million in bonds. Suddenly, there was this hot new market. Traders started gathering under a big buttonwood tree right there on Wall Street, and by 1792, they decided to make it official, signing an agreement that became the blueprint for the New York Stock Exchange. So the farmland is gone, but the animal references? Oh, they're still very much around. And to survive in the Wall Street jungle, you have to know who the locals are. So let's meet the 4 main types of animals you're going to find roaming around.
All right, here's the main event, the daily tug of war. It's always the bulls versus the bears. It's actually super easy to remember. A bull thrusts its horns up when it attacks, right? So a bull is an optimist, a buyer, someone who thinks prices are going up. And a bear, it swipes its paws down. So a bear is a pessimist, a seller, betting that prices are about to take a dive. And what's really fascinating is that when enough people feel bullish or bearish, it can become a self-fulfilling prophecy, literally pushing the whole market one way or the other.
Now, here's the thing. Both bulls and bears can definitely make money. But you've got to listen to this classic Wall Street saying, because it's a huge warning about the other animals in this jungle. It goes like this: bulls make money and bears make money, but hogs get slaughtered.
So who are these other animals? Well, the hogs are the greedy ones. They're the traders who bet the farm on super risky trades, hoping to get rich quick. And, well, they're usually the ones who get completely wiped out. And then you have the sheep. They don't really have a plan. They just follow the herd, listening to hot tips from so-called gurus. And when things get shaky, the sheep are the ones who get shorn.
And this all leads us to the 2 giant invisible forces that are really in charge of all the animals in the jungle. You can't see them on any chart, but they are behind almost every single decision. I'm talking about the raw, powerful emotions of greed and fear. You know the feeling. You buy a stock and it immediately jumps up. That's when that little voice of greed starts whispering in your ear, right? It's telling you, this is it. Go all in. You're going to make a killing. It's the voice that makes you want to throw your whole strategy right out the window for a shot at a fantasy payday. And then you've got its terrifying twin, fear. The market opens, and it's a sea of red. Your stock is plummeting. That sick, panicked feeling in your stomach as you watch your money just disappear? That's fear. and it makes you want to hit the sell button at the absolute worst possible time. So here's the absolute key takeaway. Your wheel advantage, your edge in the market, it doesn't come from some secret formula. It comes from learning how to recognize and control these two emotions. Seriously, the trader who can keep a level head while everyone else is either getting greedy or panicking, that person has a huge advantage over almost everybody else.
Okay, now that we get the emotional side of things, let's talk about the fundamental law of the jungle. I'm talking about supply and demand. And honestly, the best way to understand this is to go all the way back to childhood and a simple cookie jar.
Imagine your mom tells you, no more cookies. Now, yesterday you didn't even care about cookies, but today, because your supply has been cut off, your demand just goes through the roof. It's all you can think about. A little later, you discover there's only one cookie left, just one. Now the supply is tiny, and of course, your brother sees it at the exact same time. All of a sudden, you're in a bidding war, and you're willing to give up your entire allowance just for that one cookie. The price just skyrocketed. And that simple little story, that is the engine that drives the entire market. Stocks work the exact same way. When tons of people want to buy a stock, that's high demand, but very few people are willing to sell it, that's a limited supply, the price has no choice but to go up. And on the flip side, when everyone's trying to sell, that's high supply, and nobody wants to buy, low demand, the price falls until it's cheap enough to attract a buyer. It really is that simple.
Okay, so you know the history, you know the animals, and you know the fundamental laws of the jungle. The very last piece of the puzzle is knowing where all this action is happening. In the US, there are two main trading arenas, and each one has a totally different personality.
So on one hand, you've got the New York Stock Exchange, the NYSE. Think of it as the old guard, kind of dignified. It's home to those big, iconic blue-chip companies like IBM and GE. But then you've got the NASDAQ. It's the younger, all-electronic upstart. It's basically a playground for day traders. It's packed with tech giants like Microsoft and Google, and it is known for being a much wilder, more volatile ride. So we've toured the entire Wall Street jungle, all the way from its humble beginnings to the animals that live there, and we've even seen how a forbidden cookie jar explains its most basic law. The only question left is, now that you've had a look around, if you were to step into this jungle, which animal would you be?
Hey everyone, and welcome. So today we're going to talk about something absolutely crucial. We're going to dive into what it takes to treat day trading not like some lottery ticket, but like a real, structured business. And trust me, that's exactly what it needs to be. So, you want to be a day trader, huh? It's the big question, right? It's easy to get drawn in by the allure of the markets, the fast-paced decisions, the potential for big profits. But hold on, before we go any further, let's get one thing straight right from the very beginning.
You've got to forget about luck, seriously. This has nothing to do with getting lucky on some hot tip you heard about. The traders who actually make it, they approach the market every single day with a plan, a solid strategy, and a firm set of rules. And guess what? We're going to start building that exact framework right now.
All right, first things first, let's talk about the absolute foundation of everything, the right kind of capital. Before you even think about placing a trade, you have to get your head around the nature of the money you're putting on the line. Okay, this right here, it's a non-negotiable rule. You can't ever trade with what's called scared money. What's that? It's money you can't afford to lose. We're talking mortgage payments, grocery money, that kind of stuff. The moment you do that, fear takes the driver's seat. And let me tell you, fear is the absolute fastest way to make some truly catastrophic decisions in the market. So let me say it again, in a slightly different way. You should only be trading with money you can genuinely afford to lose. Look, the market is a tough, tough teacher. And the hard reality is most new traders, they lose money at the start. It's just part of the learning curve. You have to be mentally and financially prepared for that. And that means only risking capital that, if it disappears, won't completely devastate your life. Okay, so once you've got your capital sorted out, the next big question is, well, it's about you. Who are you as a trader? What are your goals? And be honest here. How much time can you realistically commit to this? Because the answer to that question is what's going to define the kind of business you're actually building. So let's break it down into two main paths. On one side, we've got the part-time trader. You know, maybe you're making fewer than 3 trades a day, maybe you're holding positions for days or even weeks. You study in your spare time. Then, on the other side, you've got the serious trader. This person is in the market every single day it's open, jumping in and out of trades in seconds or minutes, aiming to do this for a living.
Which one sounds like you? Your answer here is going to dictate pretty much everything that comes next, so it's super important to be honest with yourself. Every business has a product line, right? Well, for a trader, your products are the things you actually trade. So what are your options? Well, you've got stocks. That's the classic choice. Everything from calm, steady blue chips to those super volatile tech names. Then there are ETFs, which are cool because they let you trade a whole industry, like banking or semiconductors, all in one go. And then you've got the mini stock index futures. Man, that is a fast-paced game with huge leverage and, you guessed it, substantial risk. It's really not for the faint of heart. The key is to match your product to your own personal risk tolerance. Okay, so you've figured out what kind of trader you are, and you've picked your product line. Now you need the right tools for the job. You can think of your broker and your trading platform as your business's headquarters. It's mission control. And this choice really comes down to that trading style we just talked about. For the part-time or swing trader, a standard online broker is often a great fit. They're usually simpler, lower cost. But for the serious active trader, a direct access broker is pretty much essential. So what's the big difference? It all boils down to two words: control and speed. With direct access, you control how your order gets to the market, which can give you a massive speed advantage. And it also gives you access to a professional-grade tool that's standard for them, something called the Level 2 screen. So, what the heck is this Level 2 system? Okay, think of it like having X-ray vision for the market. Instead of just seeing one price for a stock, you get to see the entire order book. I'm talking about everyone who's lined up to buy and everyone who's lined up to sell, and you can see exactly what prices they're willing to trade at. And here's what it looks like. This is so much more than just a simple price ticker. On the left side, you're seeing all the buyers lined up. Those are the bids. And on the right, you see all the sellers. Those are the asks. For a serious day trader, this information is absolute gold. Why? Because it shows you the raw supply and demand in real time, which can give you a critical edge in speed and execution that you just can't get from a standard quote. Okay, check it out. You've got your capital figured out, you know your business model, and you've picked your tools. But just like any business on the planet, you've got overhead, you've got operating costs. And in the world of trading, these costs can be really insidious. They can sneak up on you and just completely destroy your profits if you're not paying close attention.
So the first hidden cost we need to talk about is something called slippage. Here's how it works. Let's say you click to buy a stock at, $29.50. But by the time your order actually goes through, you get filled at $29.55. That extra 5 cents, that's slippage. Now, it might not sound like a big deal, but multiply that by hundreds of shares over dozens and dozens of trades, and it suddenly becomes this massive profit-eating monster.
All right, now let's talk about the most obvious cost, the one everyone knows about: commissions. The problem is, it is so easy to underestimate them. Let's just run some simple numbers. Say you make 10 trades in a day, and each trade costs you $20. That's $200. $200 in overhead before you've even made a single penny in profit. That sounds kind of manageable, right? Well, let's see. But watch what happens. That $200 a day, over a pretty typical 20-day trading month, suddenly becomes $4,000. Now that is a significant chunk of change you have to earn back just to break even. The pressure is already building. And what about over a full year? Well, now you're looking at close to $50,000, 48 grand paid directly to your broker and commissions. Now look, the point here isn't to scare you off. It's to make you realize that managing your costs and avoiding overtrading has to be a core part of your business strategy. It's not optional. So let's do a quick recap. We've talked about capital, we've talked about your identity as a trader, your tools, and your costs. Now it's time to put it all together into a simple, written document. This is your rulebook, your playbook. This is it, this plan. This is what's going to keep you disciplined when the market is going absolutely nuts. It's the one thing that separates professional traders from gamblers. This is your guide, your North Star for every single decision you're going to make. So what exactly goes into this rulebook? Well, here's a great place to start. Rule number 1, never ever risk more than a small percentage of your account, let's say 2% on any single trade. Rule number 2, you need to set a maximum loss you're willing to accept for the day. And once you hit that number, you stop. You're done. No exceptions, no one more trade. And when it comes to your goals, and this is huge, focus on the process. Focus on making high-quality, well-planned trades. Do not focus on making a certain amount of money each day. The profit, that's just a byproduct of having a really solid process. So there you have it. You've got the blueprint for your trading business. But,
A blueprint isn't a building. The real work, that starts right now. It's studying, it's practicing, and it's constantly refining that plan. And please, before you risk a single real dollar, I want you to seriously consider paper trading. Practice executing your business plan over and over again, but without the emotional pressure of real money on the line. So the final question is, are you really ready to do the homework? That's the question that truly matters.
So what's the real secret sauce that separates a winning trader from, well, everyone else? I'll give you a hint. It's not about having some magical chart set up or a secret strategy. It's all about their mindset. Today, we're going to crack the code on the psychology that puts the top traders in a league of their own. Believe it or not, experts pretty much all agree on this. They say successful trading is only about 10% methodology. You know, the charts, the indicators, all that technical stuff. The other 90%, a whopping 90%, is all about mental discipline. The real battle is fought right between your ears. And you know, that massive mental component is probably the #1 reason for this pretty scary statistic. Somewhere between 80 and 90% of all traders eventually just crash and burn. They don't just lose money, they lose their confidence, and they're out of the game for good. Okay, so that leads us to the single most important question we can ask, right? If the mental game is pretty much everything, how do you actually build a mindset that lands you in that elite, successful 10%? Well, that's exactly what we're going to break down, step by step. All right, here's our roadmap. First, we'll double down on why it's a mental game. Then, we'll cover 2 non-negotiable rules you have to live by. After that, we're going to look at the market for what it really is, pinpoint your actual enemy, and finally, put all the pieces together to build that winning mindset. So let's start with the big one, the mental game. And I really want to drive this home. This isn't just some abstract idea. Your psychology isn't just a part of the game. It literally is the entire game. And that brings us to 2 incredibly simple, almost profound rules. Think of these as etched-in-stone commandments. They're not suggestions. They have to guide every single click you make in the market. They sound almost too simple, don't they? Rule 1, protect your principal. And Rule 2, trade to trade well, not to make money. I'm telling you, almost every professional trading concept you'll ever learn points right back to these 2 pillars. Getting these right is everything. Let's really change how you see your trading capital. It is not just money. It's your most important tool. It's your hammer, your scalpel, your paintbrush. Without it, you can't work. You're out of business. So you have to guard it like your life depends on it. From silly mistakes, from revenge trades, from any risk that just isn't worth it. This quote from the legendary investor Jimmy Rogers, it captures this idea perfectly. Now, it sounds like he's being lazy, right? But he's talking about the total opposite. He's talking about extreme, almost superhuman patience. He waits for the absolute best opportunities, the no-brainers, instead of forcing trades because he's bored or feels like he needs some action. And this leads us right into the paradox of Rule 2. Look, the second you start thinking, oh, I'm up $50, now I'm up 100, while you're in a live trade, your decision-making is shot. Your goal is not to make money. Your goal is to execute their plan perfectly. When you focus on the process, on the art of trading well, the money just follows. It becomes a byproduct of excellence. Okay, so we've got our internal rules dialed in, but now we have to understand the arena we're playing in. And this next idea, man, it's so fundamental to staying sane as a trader. This little phrase says it all. The market is just a force of nature. It's like an 800-pound gorilla. It does whatever it wants, whenever it wants. Your opinions, your analysis, what you think should happen. None of it matters. The market just is. You really have to let this sink in. The market doesn't know you exist. It doesn't care if you win or lose. It's just a giant impersonal machine that facilitates transactions. And whatever price you see on the screen right now, that is the right price. That is the truth. You can't argue with it. All you can do is react to it. So, if the market isn't the bad guy, who is? Because trust me, there is a battle being waged. But your biggest enemy is way, way closer to home than you might think. Yep, your most lethal enemy is emotion. You could be the best chart reader in the entire world, but if you let greed, fear, or your ego's need to be right take the wheel, you are going to lose. It's not an if, it's a when, period. This just perfectly illustrates the difference. On the outside, the action for both traders is identical. Point, click. But look at the inside. One trader's feeling the FOMO, the adrenaline, their heart's pounding. The other is calm, confident, just following a plan. The internal state is what dictates the long-term outcome. So this brings us to the most important part of this whole thing. How do we actually do it? How do we go from being that heart-pounding, emotional trader to the calm, confident professional? How do we build that winning mind? Here's the secret. You don't conquer fear. You can't just will it away. You have to displace it. Think of it like a bucket of water. You can't take the water out, but you can put a rock in, and the water level rises. First, you put in the rock of knowledge. You study like crazy. Then you add the rock of experience, just pure screen time. And when you combine knowledge and experience, you get the most precious gift of all, genuine self-trust. Now, this new mindset is held together by two final pillars. First, radical responsibility. You have to own every single outcome. The market didn't take your money. You chose to enter a trade. No blame, just lessons. And second, respect. Respect for the craft, for your abilities, and for your capital. The way you treat your money is a direct reflection of how you value yourself. Ultimately, becoming a winning trader isn't just about learning a skill. It's about personal growth. It forces you to step way outside your comfort zone. You actually have to become a bigger, more disciplined version of yourself to handle the success you want. So the final question is really for you. Are you willing to do that? Are you willing to extend your reach? Have you ever looked at a stock chart and just felt completely lost? Like you're staring at some ancient alien language? Trust me, you are not alone. The world of trading can feel so chaotic, so random. But what if I told you that you can learn to speak that language? All right, let's dive into this explainer and pull back the curtain on the fundamentals of trading. You know, this quote from an old school trader just says it all, doesn't it? It perfectly captures the beautiful and incredibly frustrating thing about the markets. Just when you think you finally figured out a rule, nope, the market does the exact opposite. It's a world built on contradictions. And this, right here, is the very first thing you have to wrap your head around. There are no unbreakable laws. There's no magic formula that works every single time. The market is a living, breathing thing, and it's being pushed and pulled by millions of human emotions every single second. So learning to embrace that chaos is actually the first step to making sense of it. That's the billion-dollar question, isn't it? I mean, if everything is always in flux, how can anyone possibly make a good decision? Well, as it turns out, traders have developed some pretty clever ways of thinking to help them navigate all that noise. When you strip it all down, it really comes down to two main philosophies, two different ways of analyzing stocks. You can think of them like two different pairs of glasses you can put on to look at the exact same company. Each pair reveals something totally different. So on one side, you have fundamental analysis. This is all about the company's story. You know, its earnings, its debt, its competition. It's for long-term investors trying to figure out a company's real value. Then, on the other side, you've got technical analysis. And these folks, they could not care less about the story. For them, it is all about the price, the volume, and the patterns on a chart. They believe everything you could possibly need to know is right there in the price history. The source material even compares them to Republicans and Democrats, two groups that see the world in fundamentally different ways, but both believe they're right. Okay, so beyond your philosophy, you also need a strategy that actually fits your life, and maybe even more importantly, your personality. Are you built for the long, patient game, or do you need that fast-paced, lightning-quick action? And your options really run the gamut. You could be a position trader, holding a stock for weeks or even months. Or you could be a swing trader, looking to catch a move over just a few days. Then there's day trading, where you're flat, in and out by the end of the day. And at the far end of the spectrum, you've got scalping, where a trade might last just a handful of seconds. Each step down that list demands more of your time, more focus, and a much quicker trigger finger. So you gotta ask yourself, what's your style? Are you the patient plotter, totally cool with waiting for a thesis to play out? Or are you more of an adrenaline addict who thrives on that minute-by-minute chaos? Being really honest with yourself about this is absolutely crucial to finding a style you can actually stick with. All right, so for the rest of this explainer, we're gonna put on our technical trader hat. And for a technician, their entire world, their whole universe really, is the chart. It's their most important tool. This is the one you've probably seen a million times. It's a simple line chart, and it just connects the closing prices over time. It's fantastic for getting a quick glance at the big picture, the general trend. But it leaves out a ton of the drama that happened during each day. So, let's level up. A bar chart gives us a lot more info. Each one of those vertical lines shows you the entire trading range for the day, from the absolute low to the absolute high. That little tick on the left, that's the opening price. The tick on the right is the close. Now we can actually see how much the stock bounced around each day, not just where it ended up. But this is what most traders live and die by, the candlestick chart. Now, it has the exact same 4 pieces of data as the bar chart, open, high, low, and close, but it displays it in a way that is so much more visual, so much more intuitive. The color and the shape of these little candles can tell you a whole story in a single glance. So here's the quick and dirty breakdown. That fat part in the middle, that's the real body. If it's green or white, it means the stock closed higher than it opened. A good day for the buyers. If it's red or black, it closed lower, a win for the sellers. And those thin lines poking out, we call those shadows or wicks, and they show you the day's absolute high and absolute low. Simple but incredibly powerful stuff. Because here's where it gets really interesting. Once you understand what a single candle is telling you, you can start to see how groups of them form patterns. And these aren't just random squiggles on a screen. They are a visual record of the battle raging between buyers and sellers. And this is the secret sauce, right? These patterns tend to repeat themselves over and over again because human emotions, fear, greed, hope, memory, they don't really change. A candlestick pattern is just a snapshot of the market psychology. It's a story about who's winning the fight in that moment. Okay, let's look at a classic. This little guy is called a hammer. See how it has a small body up top and a really long lower shadow? This pattern usually shows up after a stock has been falling, and it tells a very specific story. The sellers pushed the price way down during the day, but then, bam, the buyers stormed back in and drove the price all the way back up to close near where it opened. The buyers are starting to fight back. Now let's see one in the wild. Check out point D on this chart of Halliburton. The stock was in a clear downtrend, and then, boom, this perfect little hammer appears. It's like a signal flare, showing that buyers finally found a price they were willing to defend. And look what happened the very next day. The price gapped up. That hammer marked the bottom. All right, let's flip the script and look at a bearish pattern. This one is called a bearish engulfing pattern, and it's just as aggressive as it sounds. It happens after an uptrend. You get a small up day, followed by a massive down day, where the red body completely swallows or engulfs the previous candle. The story here is a sudden, violent shift in power. The sellers didn't just show up, they took complete control. Back to our Halliburton chart. See point A, way up at the top? After a really nice run, this huge black candle just obliterates the prior white one. That was a massive warning sign that the party was over, and sure enough, the stock rolled over and fell hard right after. Okay, one more for you. The shooting star. It's basically just an upside-down hammer. It shows up after an uptrend, and it has that long upper shadow. And the story it tells? The buyers tried their best to keep pushing the price higher, but the sellers showed up in force and slammed it right back down. It's a classic sign of exhaustion. The buyers are running out of gas. And here it is again on our chart, right at point E. After that insane, almost vertical run-up, the shooting star appears. The buyers made one last desperate push, but they were tired. The sellers took over, and the very next day confirmed that reversal with a big drop. See how these patterns give you a heads up? So let's just quickly recap the big ideas here. First, remember that the only rule is that there are no rules, only constant change. Second, you can analyze the market using fundamentals to figure out what to buy or technicals to figure out when to buy. Third, you absolutely have to pick a trading style that fits you and your personality. And finally, remember that these candlestick patterns aren't just squiggles. They are the visual language of the market's emotions. Look, learning this stuff doesn't give you a crystal ball. It won't tell you the future, but it does give you a framework. It lets you listen in on the story the market is telling every single day. The only question left is, now that you know a few words of the language, what story will you see?
All right, let's talk about stock charts. We're going to pull back the curtain on those things that can look so complicated. Because what if I told you that inside all that noise, there's actually a pretty simple story?
You ever stare at a stock chart and just see, well, a total mess? Like a bunch of random squiggles and jagged lines?
Yeah, you are not alone. It can feel totally chaotic. But here's the thing, underneath all that seeming complexity, there's a super simple truth. I mean, no matter what's going on with the economy, the news, anything, a stock's price is only ever doing one of three things. And getting a handle on these three directions, well, that's step one. It's the foundation for reading any chart. Seriously, that's it. It's either going up, going down, or moving sideways. Every little wiggle on a 1-minute chart, every massive 10-year trend, it all fits into one of those three buckets. That's where we start. Pretty simple, right? Okay, so how do we make sense of all this over time? Well, it helps to kind of shift how you look at it. Instead of a boring financial graph, let's start thinking of it like a landscape, a map of a journey that's just waiting to be explored. I mean, think about it, right? Our whole world is built on cycles. You got the seasons, the tides, and the market. It's no different. It's driven by people, by human emotions like fear and greed, and because of that, it moves in these patterns that are, surprisingly predictable. And this really drives the point home. See, when you zoom out, it stops looking like just random noise. It starts to look like a mountain range, with these peaks and valleys that tell a story. The story of a journey over time. And just like any good journey, this one has different parts, right? Different stages. We can actually break down a stock's trip through this mountain range into 4 clear phases, kind of like the 4 seasons. So here they are. You got the basing phase, then the uptrend, then what's called the distribution or topping phase, and finally the downtrend. If you can learn to spot these 4 phases, the whole story of the chart just starts to click. Okay, let's get into a real-world example. This right here is the NASDAQ 100 from 1996 to 2006. This is one of the most famous market cycles ever. Now, don't get overwhelmed by all the details. We're going to walk through this whole thing together, one phase at a time. So, looking at our NASDAQ chart, see that kind of flat part way over on the left from 96 to 97? That is phase 1. That's the base. The stock is just resting. It's also called the accumulation phase because this is when the really smart money, the savvy investors, start quietly buying shares. Then, right after that flat basing period, boom, we get the climb. That's phase 2, the uptrend. The price just breaks out of that valley and starts making a series of higher highs and higher lows. This is when the buyers are totally in control and you start to see the public getting really excited. Now we get to the very top of the mountain, right around the year 2000, and the climb just stalls out. This is phase 3, distribution. You can think of it like a big battle between buyers and sellers. Those early investors who got in at the bottom, they're starting to sell. They're distributing their shares to all the people who are just now jumping in because of the hype. And after that big fight at the top, well, the sellers win. And that kicks off phase 4, the downtrend. It's basically a mirror image of the climb up, right? You see a series of lower highs and lower lows. And with that, the cycle is complete, and it eventually finds a new bottom, a new base to start all over again. Okay, so let's zoom in a bit on those sideways parts, the base at the bottom and the distribution at the top. Because here's the thing, not all sideways movement is created equal. Sometimes you get a nice, predictable range that you can trade. Other times, it's just a messy congestion pattern that's probably best to just stay away from. But then there's consolidation, and that's special. That's like a coiled spring, just building up energy for a huge move. You can see the difference really clearly here. The range is pretty clean, right? Orderly. The congestion, well, it's just a chaotic mess. But look at the consolidation over on the right. See how tight and orderly that is? That's a sign that pressure is building for a big, potentially explosive move. All right, so we've got the 4 seasons of the market down. But to really navigate this landscape, we need some landmarks on our map. And in the world of trading, the most important landmarks you'll ever find are called support and resistance. Or, let's make it even simpler, floors and ceilings. It's actually a really simple idea. Support is just a price floor. It's a level where a bunch of buyers step in and basically say, nope, we're not letting it go any lower than this. And resistance? That's the ceiling. It's a price level where sellers show up and say, all right, that's as high as this thing is going for now. To make this super clear, just picture the stock price as a ball bouncing inside a room. When it hits the ceiling, that's resistance. When it falls and bounces off the floor, that's support. And for a while, it can just bounce back and forth, between that floor and that ceiling. But, and this is the really important part, What happens if that ball breaks through the ceiling? Imagine it smashes right through and goes into the room on the next floor up. Well, that old ceiling it just broke, that now becomes its new floor. It's a new level of support.
And, you guessed it, it works the exact same way in reverse. If the ball falls through the floor and down into the basement, that old floor it just broke through is now the new ceiling. It's a new level of resistance. This idea, this role reversal, where old ceilings become new floors and old floors become new ceilings, it is absolutely fundamental. You gotta know this to read charts.
Okay, so let's recap. We've got the market seasons, we've got the floors and ceilings on our map, so how do we put all of this together to spot a really big move?
What we're looking for is something called a breakout. This is that awesome moment when our bouncing ball doesn't just tap the ceiling, it rockets right through it. A breakout is a huge signal. It tells you the balance of power has totally shifted and the buyers are now firmly in charge. So let's circle all the way back to where we started. The next time you pull up a stock chart, what are you going to see? Is it just going to be a bunch of chaotic, random squiggles? Or are you going to see a landscape with its own seasons, its own floors and ceilings? A story that's just waiting for you to read it.
Welcome. You know, if you've ever felt completely lost staring at a stock chart, you're definitely not alone. It can feel like this total maze of confusing jargon. But what if I told you there's one simple tool that could tell you the real story behind the price? Well, today, we're going to learn the market's secret language. So our story kicks off with a trader who thought she had the perfect trade. The market was tanking, so she shorted a weak stock, basically betting it would keep dropping, and she was right. The profits were just piling up. She was absolutely crushing it. And then, bam, this happened. The stock didn't just stop falling, it reversed and shot upwards like a rocket, wiping out every single penny of her gains, and then some. She was just left in total shock. I mean, what on earth just happened? There was no news, no big announcement, absolutely nothing to explain this insane reversal. It's the kind of thing that makes traders question everything they thought they knew. And it's the mystery we're about to solve right now. So in a complete panic, she scrambles over to the desk of a veteran trader, a guy named Greg Capra. And as she's frantically trying to explain what happened, this little crowd of other traders starts to gather around, leaning in, totally expecting to hear some kind of super secret, complex formula. You know, they were ready for some deep dive into Fibonacci levels or stochastic oscillators. But Greg Capra? He didn't even flinch. He just glanced at her chart, and with this incredible calm that just cut right through all the panic, he said 4 simple words: more buyers than sellers. That's it. No complicated theory, no secret indicator, just the most basic, fundamental truth of how markets work. And that right there is the key to everything we're going to talk about today. It sounds almost too simple, doesn't it? But we forget it all the time. A stock goes up for one reason and one reason only. More people want to buy it than sell it. And it goes down when there are more sellers than buyers. Everything else is just commentary. It's so easy to get sucked into what the source calls the paralysis of analysis, just drowning in dozens of indicators. The key is to always come back to this simple idea: supply and demand. So, how do we actually see this tug of war between buyers and sellers? Well, that's where trading volume comes into play. It's simply the total number of shares that change hands in a certain amount of time. You see it as these vertical bars right down here at the bottom of the chart. Think of it as a peek behind the curtain, a window into the market's true conviction. Now, this is what makes volume a total game changer. See, most of the technical indicators you'll ever use are just fancy calculations based on price. They're like looking in the rearview mirror. They tell you where the stock has been. But volume is different. It's a totally independent piece of the puzzle. It gives you a clue about the strength behind a price move, and even more importantly, what might be coming next. And this brings us to a golden rule from the legendary technician Joe Granville. He said, volume precedes price. Think of it like this. A huge surge in volume is like the thunder you hear in the distance, and the big price move is the lightning that follows. It's the market's own early warning system. Let's see what this actually looks like. So over here on the left, you've got a classic breakout. That's when a stock's price punches through a ceiling, or what we call a resistance level. As it breaks through, notice how the volume just explodes. That is the big thumbs up, the confirmation you're looking for. Then, on the little dip that comes right after, the pullback, look at how the volume just dries up. That tells you the sellers aren't really committed. It's a super bullish sign. And you guessed it, the exact same logic works in reverse for a breakdown, which you can see here on the right. This is when the price falls through a floor or a support level. As it breaks down, again, you see that huge spike in selling volume. That's the conviction. Then when the price tries to bounce back a little, the volume is super low. That tells you the buyers are weak and the downtrend is probably going to continue. And here's a real-world example from a chart of Deere & Company. Just look where these arrows are pointing. Each and every time the stock makes a big, meaningful move higher, it's driven by a big spike in volume. This isn't just a stock slowly drifting up. It's being pushed higher with real force, with real money behind it. This is exactly what a healthy, sustainable uptrend looks like. Okay, so volume is great for confirming a trend's strength. But you know what? It can also be an amazing warning system, telling you when a trend is getting tired and might be about to end. So let's dive into two of the most important red flags volume can give us. The first red flag is something called a climactic volume spike. Now, this is a massive, totally unusual surge in volume that shows up after a stock has already been running in one direction for a really long time. Here's a perfect example from a chart of Armor Holdings. The stock has been in an absolute free fall. Then, right at the very bottom, look at that gigantic volume spike. That is the moment of maximum panic. It's when every last seller is just desperate to get out. But think about it. Who's on the other side of all that selling? The big institutional buyers, stepping in to soak it all up. This is called capitulation, and it often signals a major turning point in the stock. All right, our second red flag isn't so much a pattern on the chart, but a type of stock you really got to be careful with, what we call thinly traded stocks. These are just stocks that don't trade very many shares on an average day. The big danger with these stocks is a lack of liquidity. What that really means is, if you decide you need to sell, there might not be anyone there to buy your shares. This can lead to these terrifying price gaps where the stock just plummets, and you're basically trapped. The author of our source material gives a really simple rule of thumb to stay safe. Just avoid trading any stock that trades fewer than 300,000 shares a day on average. Okay, let's wrap this all up with a simple volume rulebook you can start using today. Step 1. Use high volume to confirm a strong move. Step 2. Avoid weak moves on low volume. They're probably traps. Step 3. Spot reversals with those big climacular volume spikes. Step 4. Check for exhaustion. That's when a new price high happens on decreasing volume. And step 5, stay liquid. Avoid those thinly traded stocks so you never ever get trapped. So, the next time you pull up a stock chart, don't just stare at the price. Glance down at those volume bars at the bottom. They're telling you the real story, the story of conviction, of emotion, and of what might happen next. The only question is, now what are the charts telling you? All right, welcome. Today, we're going to break down a pretty intense 2-week trading bootcamp. And the whole point of this? To build a rock-solid foundation of skills and discipline all before you even think about putting a single penny on the line. Okay, so let's get right into it. Your very first mission, and this is probably the most important rule of the whole thing, is going to sound a little weird. You are forbidden to trade. Seriously, not one trade. Don't even think about clicking that mouse. Yep, you heard me right. This bootcamp, especially at the start, has nothing to do with making money. Zero. It's all about soaking up priceless knowledge, gaining experience just by watching the market quietly. And trust me on this, learning the discipline of sitting on your hands, it's going to be one of the most powerful tools you'll ever have. Okay, so let's talk about week 1. This is where the drills begin. For the next 5 days, your entire job is to become an expert observer. You're going to learn how to watch the market like it's a battlefield, to really understand its rhythms, its flow, and even the personalities of the individual stocks. So here's the game plan for that first week. It's a 5-day mission, and you'll see how each day kind of stacks on top of the one before. Day 1, you just pick one stock. That's it. Then you add another from the same group. Then you start comparing them to the big indices. It's all about starting small and slowly zooming out, sharpening your focus from one little tree to the entire forest. So on that first day, just watching that one stock, you're going to realize something really cool. Stocks have personalities, for real. And you'll learn it by watching them at these really specific times of day. What does it do right at the opening bell? Does it go crazy? Or how about during lunchtime, that noon lull? Does it just go dead? And that final hour? you start picking up on these patterns. These are its tells, just like in poker.
And this, right here, this is a huge piece of advice, a real pro tip. That first 5-10 minutes of the day, it's pure chaos. It's a Wild West show run by the market makers. So what do the pros do? They wait. They let the dust settle. They let the amateurs get shaken out before they even think about making a move. That's discipline.
All right, you made it through week 1. All you did was watch, and that's huge. Now for week 2, we're going to get a little more advanced. You're ready to learn how to see what's really going on beneath the surface, beyond what the Dow and the S&P are telling you. This is where we start learning the market's secret language. We're talking about market internals. Seriously, these are like the secret weapons of pro traders. Think about it. The major indices, they can put on a happy face for the public, right? But these internals, they're like an X-ray. They show you the real story, the true health of the market that most people are completely blind to. Okay, so first up is something called the tick. The easiest way to think about it, it's the market's pulse in real time. If the number is positive, it just means more stocks are going up than down right now. That's bullish. If it's negative, more are going down, bearish. It's really that simple, but man, is it powerful.
And this chart really breaks it down for you. What you're looking for are the extremes. When you see that tick reading get crazy high, like over 1,000, that's not the time to get excited and jump in. No. That's the time to get nervous. It means the market is overbought. I love this analogy. It's like it just ate way too much chocolate cake and is about to get really, really sick. Okay, so if the tick tells you how many soldiers are marching forward, the next indicator, the trend, tells you how much ammo they're carrying. It's not just about the number of stocks moving up or down. It's about the volume behind them, the power, the conviction. That's a huge piece of the puzzle. So here's the key takeaway, the thing you have to remember. These two indicators often work together, but kind of in opposite ways. For a really strong bullish setup, what do you want to see? You want a positive tick, meaning lots of stocks are going up, and a falling trend, meaning there's heavy buying volume behind them. That's the sweet spot. Okay, so you've learned how to watch the market, you've learned how to read its secret signals. Now let's talk about the gear, the toolkit. These are the basic commands and tools you'll need when you finally get that green light to actually place a trade.
First up is the level 2 screen. I know, it looks like something out of the Matrix, right? Super intimidating. But just think of it as a live look at supply and demand. Your chart shows you what happened. This thing shows you what's happening right now. The most important part, that time and sales window. That's the proof. It shows every single trade as it happens. And here's a pro tip. When you see a huge order come through, a big size, that's the footprint of a big institution. You probably want to be trading on their side, not against them. Let's talk order types. First, the market order. This is basically the panic button. It's your get me in or get me out right now order. It's super fast. But here's the catch. You're telling the market you'll take whatever price they give you. You give up all control over the price, and in a crazy market, that can cost you. Then you've got the limit order. This is the sniper rifle approach, not the shotgun. You name your price. You say, I will buy this stock at this price, and not a penny more. It gives you total control over what you pay. The only downside? The stock might never come down to your price, and you could miss the trade. And last, but maybe most importantly, is the stop-loss order. This is your eject button. It's your safety net. It's a preset order that automatically sells your position if the trade goes bad. It's how you make sure a small, manageable loss doesn't turn into a total account blow-up. It's not optional, it's essential. And just like that, you're done. You've completed the 2-week boot camp. And the stuff you've just learned just by watching and being disciplined, I'm telling you, it is more valuable than you can possibly realize right now. So what was the whole point of all this? It was never about making money. The goal was to learn how the market actually works, its habits, its tricks, before you put any of your hard-earned cash at risk. True readiness isn't about being eager. It's about being prepared. Think about it. You survived 2 weeks without placing a single trade. What did you learn about the market? But maybe more importantly, what did you learn about yourself? You've just built a foundation of knowledge and, crucially, self-control that most traders, frankly, only learn after losing a ton of money. You learn to be patient, to watch, to listen. And now the real work can begin. All right, let's dive right into what might be the single most important mantra in all of trading. It's a simple phrase that, honestly, separates the pros from the amateurs. Plan your trade and trade your plan. We're going to break down exactly what that means.
I mean, think about it for a second. Would a surgeon ever make the first cut without looking at an x-ray? Of course not. Would a builder start laying a foundation without detailed blueprints? No way. So why on earth would anyone risk their hard-earned money in the market without an equally precise game plan?
You know, the legendary basketball coach John Wooden put it perfectly. If you fail to plan, you plan to fail. And this isn't just some motivational quote for sports. It's a universal truth that applies directly to trading. The work you do before you even think about clicking the buy button, well, that's what really determines your success.
Let's just be completely honest here. Clicking buttons based on a gut feeling or some hot tip you heard, that isn't trading, it's gambling. And our goal today is to help you shift from that gambler's mindset to a professional one. And it all starts with your blueprint. So what does this blueprint actually look like for a trader? Well, it starts with something incredibly simple, but really, really powerful, a trading log. Look, a written plan does way more than just organize your thoughts. It literally forges discipline. When the market gets crazy and your emotions are going haywire, this log is your anchor. It's the thing that keeps you grounded. It's also your personal report card, helping you see what's working and, just as importantly, what's not. It stops you from cheating on your stop losses and helps you actually take profits when your plan tells you to, not when fear or greed starts whispering in your ear. And here's a fantastic little hot tip for you. Study after study shows that the simple physical act of writing down a goal makes you dramatically more likely to achieve it. It's the same thing with your trading plan. When you just think about your stop loss price, it's so easy to bend the rules when a stock starts to drop. But when you see that number written down in black and white, it becomes real. It solidifies your commitment to stick to the plan. This slide just brings it all to life. On the left, you've got the plan before the trade. The stock symbol, the entry price, the stop, the target, it's all there. Then, over on the right, you see the completed log after the trade was executed just like you planned. That's the whole journey right there, from blueprint to a finished, profitable structure. Okay, so you've got your log ready to go. Now, the big question is, how do you find the trades to put in it? This brings us to your core strategy. So there are basically two main schools of thought here. You have top-down traders. Think of them like airline pilots. They check the overall weather, the market trend, and then they check their specific flight path, which is the sector, before they ever worry about the individual plane or the stock. Then you have bottom-up traders. They just focus on one stock's chart, hoping it can take off even if there's a hurricane raging in the broader market. The takeaway here is pretty clear, especially when you're starting out. You want to be the pilot. Why? Well, the numbers don't lie. About 3 out of every 5 stocks will just follow the broader market up, and a whopping 4 out of 5 will follow it down. So by trading with the market's main trend, you're not fighting the current, you're riding the wave. You are putting the odds squarely on your side. And this, right here, is your pre-flight checklist. It's so simple. First, you ask, is the overall market going up? Yes or no? Second, are the internals positive? Are more stocks advancing than declining? Third, is the stock's industry group looking strong? Fourth, and this is a big one, are there any major news events like an earnings report that could cause some serious turbulence? Only if you get green lights on all of those do you finally move to the last step and look at the individual stock's chart. All right, let's talk about the math. Once you've found a potential trade that's passed your checklist, there is one simple calculation you absolutely must do. This part is non-negotiable. This right here, this is your magic number, 1 to 3. This means for every single dollar you are willing to risk if you're wrong, you should have the potential to make at least $3 if you're right. This simple bit of math is what keeps professional traders in business for the long haul. So really, all this risk-reward analysis does is force you to answer one simple question before you put a single dollar on the line. Is this trade worth it? It's not about being a fortune teller. It's about making sure that the potential payoff is big enough to justify the risk you're about to take. Let's make this super clear with an example. Let's say you want to buy a stock we'll call Dicey Delivery at $20 a share. You set your stop loss, your I'm out price, at $19. So you're risking $1 per share. Simple. Now, your analysis of the chart tells you that a realistic profit target is $23. That's a $3 potential gain. So you're risking $1 to potentially make $3. That is a perfect 1 to 3 ratio. The math checks out. It's a trade worth considering. Okay, so you have your plan, you've run your checklist, you've done the math. The final piece of this puzzle is learning to spot the visual signals on a chart that literally scream, it's time to act.
This is such a powerful idea. A stock chart is not just a bunch of random squiggly lines. It is a picture of human emotion. It's fear, it's greed, it's uncertainty, it's confidence, all playing out in real time. And because human nature doesn't really change, these emotions create patterns that tend to repeat over and over again. Learning to spot them is like learning to read the market's body language.
I absolutely love this analogy. When you see a stock just moving sideways in a tight little range, that's called consolidation. Basically, buyers and sellers are at a standstill. Think of it like you're sitting on an old mattress, compressing those springs. That pressure is just building and building. The breakout is what happens when you finally stand up. Boing! All that stored energy gets released in one powerful move.
So, what does one of these patterns actually look like? Well, here is one of the absolute most reliable patterns for beginners. It's called the double bottom, and it looks just like the letter W. It's a signal that a downtrend is running out of steam. The stock tried to make a new low and failed. Then it tried again and failed again. The sellers are exhausted and the buyers are getting ready to take charge.
Now, this right here highlights a really specific and much safer entry point. See, after that first big breakout, a stock will often have a small, very brief pullback. The safest place to jump in isn't on that first chaotic move. It's on what some traders call a nice spring day. That moment the stock moves back above the high of that little pullback, confirming that the new uptrend is for real.
And look, this isn't just theory from a textbook. Check out this real-world chart of Lear Corporation. You can see that perfect W shape forming back in March and April, and see that little pullback right after? Then, boom, an explosive rally followed. This is the pattern playing out in the real world, leading to a huge move.
Okay, one last crucial hot tip. Please don't get overwhelmed trying to memorize dozens of different chart patterns. You will make so much more money and have a lot more fun if you just master 2 or 3 of them, like this double bottom. Learn them so well you can spot them in your sleep. Seriously, simplicity is your best friend here. So let's wrap it all up. Success in trading really comes down to having a repeatable process. Number 1, get your blueprint. Write down your plan in a trading log. 2, use your pre-flight checklist, the top-down approach. 3, always do the math. Insist on that 1-to-3 risk-reward ratio. And finally, be patient and wait for your specific high-probability chart pattern to show up. You now have all the core pieces of a professional trading plan. You've got the map, you've got the checklist, and you know the signals to look for. The only question left is, what are you going to do with it? What's your first well-planned trade going to be?
Welcome to The Explainer. Today, we're jumping into the world of swing trading to break down a really powerful setup, one that a lot of traders swear by. We're going to learn how to spot it, how to trade it, and most importantly, how to manage the risk. And you might be surprised to find out that the secret to all of this starts in a very, very unexpected place.
I know. It sounds a little strange, right? But believe it or not, a math problem about how fast rabbits multiply, first dreamed up over 800 years ago, actually reveals a hidden rhythm in the natural world. And, as it turns out, many traders are convinced this exact same rhythm is what drives the financial markets. Let's dig in.
So it all began with this guy, nicknamed Fibonacci. He posed a simple question. If you start with just one pair of rabbits, how many pairs will you have after a year? Well, the answer to that little puzzle unlocked a sequence of numbers that seems to pop up absolutely everywhere in nature.
The pattern itself is incredibly simple. You just add the last 2 numbers together to get the next one. So you get 1, 2, 3, 5, 8, and on it goes. But this isn't just some math class trick. It's like a fundamental building block of the universe. You can see it in the spiral of a seashell, the way a tree branches out, and even in the shape of entire galaxies. It's wild.
Now, as this sequence gets bigger and bigger, the ratio between any number and the one right before it gets closer and closer to this one specific number, 1.618, also known as the golden ratio. It's this proportion that you see all over nature and art, and it's a huge deal for analysts who believe markets move in these predictable waves and cycles.
Okay, the golden ratio is fascinating, but for our purposes as traders looking for an edge, the real magic is in those first few numbers of the sequence. Why? Because you see this rhythm all the time. A stock in a strong uptrend will often shoot up for 3 days, then pull back for 2. Or maybe it rallies for 5 days, then retraces for 3. This pattern is everywhere once you start looking for it.
And this quote from the legendary trader Martin Schwartz just nails the human behavior behind those numbers. He called it his 3-day rule. Basically, by the third day of a huge move, the smart money has already cashed in. He said chasing the trend at that point is what he called a sucker play. So we have this natural kind of 3 steps forward, 2 steps back rhythm, but how do we take that and turn it into a strategy we can actually use? Well, let's translate it into a simple but really powerful visualization.
I want you to imagine you're tossing a basketball up a flight of stairs. It doesn't just fly straight to the top, right? No, it bounces up, loses a little bit of height, hits a stair, and then bounces again, continuing its way up. This is exactly how the healthiest, strongest stocks move.
Now let's look at a chart and see how this plays out. A stock in a solid uptrend will rise for a few days. That's the bounce. Then it pauses. And this pause can look like one of two things: a pullback, where it dips down a bit, or a consolidation, where it just kind of moves sideways for a bit. The stairs, in our analogy, those are key support levels, and a lot of the time they're represented by a moving average, which is just the average price of the stock over, say, 20 or 50 days. The whole setup is about buying that next bounce off the moving average stair.
Theory is great and all, but seeing is believing. So now we're going to look at some real-world examples to see exactly how this bouncing basketball pattern shows up on actual stock charts. This is where it all clicks into place.
Okay, take a look at this chart of Wheeling Pittsburgh Corp. Back in January, you see the stock break out of that sideways consolidation. That's the first big bounce. Then the stock just runs for several months. Now follow the chart over to May. See how it pulls back perfectly to that dotted line? That's the 50-day moving average. That pullback is the bounce on the stairs. And the move higher right after that, that's our perfect entry point.
Now check out Pacific Ethanol. On the left side of this chart, it gives us 3 absolutely beautiful, orderly setups, 3 clean bounces right off the moving average. But then, look what happens on the right side. The price action just gets wild and choppy with these huge up and down swings. That's the pattern breaking down. It's a critical signal telling you the stock's personality has changed and the risk has gone way, way up.
And this chart of Boeing is just textbook. I mean, you can see how the stock literally waltzes up its 20-day moving average, that solid line there. It rises, it pulls back to the line, it pauses, and then it goes again. Every single one of those pullbacks was a high probability opportunity to jump on that trend. Spotting the setup is the exciting part, for sure, but it's only half the game. What really separates the pros is how they manage risk. So let's talk about 2 absolutely crucial elements: how to handle overnight gaps and how to set smart stop losses.
A gap opening, this happens when some news comes out or there's a huge flood of orders before the market even opens, and the stock just starts trading at a totally different price from where it closed. If you're on the right side of it, it's instant profit. If you're on the wrong side, well, it can be a really painful surprise.
So how do you read a gap? The key almost always is volume. A gap up on huge volume shows real buying power, real conviction. That move is probably going to continue. But a gap up on light volume? That's weak. It suggests there's no real muscle behind the move, and short sellers are probably going to jump all over it and push the price right back down.
To protect yourself, you absolutely have to know your stock's personality. Is it a calm, orderly stock that just waltzes smoothly upward, like that Boeing chart? Or is it a volatile, wild stock that jitterbugs all over the place? Your risk management, especially where you put your stop loss, has to match that personality. A trailing stop is a fantastic tool for this. You can see how it works in the diagram. First, you set an initial stop loss below where you got in to define your maximum risk. Then, as the stock starts moving in your favor, you move that stop up, trailing it just below the new price levels. This does 2 things. It locks in your profits while still giving the stock some room to breathe and keep climbing.
Okay, we've covered a ton of ground. The Fibonacci rhythm, the bouncing basketball setup, we've looked at real charts, and we've talked risk management. So now let's pull all of that together into a simple, actionable checklist you can use to find these setups.
Before you even think about clicking that buy button, you've got to run through this list. Step 1. Is the trend your friend? Is the stock clearly moving up? Step 2. Has it paused near a key support level, like that moving average? Step 3. Check the volume. Did it dry up during the pause? That's a great sign that sellers are losing interest. 4. Look for a reversal candlestick pattern, something like a doji or a hammer, that hints the direction is about to change. And finally, step 5. Plan your entry for after the price confirms the move by breaking higher. This is your filter to find only the best high-probability trades. And here's one final hot tip to keep in your back pocket. A
A stock that finishes the day at or really close to its high, especially if volume picked up into the close, is showing incredible strength. That's often a huge sign that the momentum is going to carry right over into the next day.
So here it is, the most important takeaway of all. Learning to recognize this pattern, honestly, that's the easy part. The real challenge, the thing that separates the traders who make it from everyone else, is having the patience to sit and wait for these A-plus setups to appear, and then having the discipline to execute your plan, manage your risk, and just walk away when the pattern isn't perfect. That right there is the real work.
All right, we are about to jump into one of the most intense, high-speed arenas in the entire financial world. So you're going to want to strap in, because today we're explaining scalping.
This single quote, it perfectly captures the heart of what we're exploring today. This isn't just trading, it's more like aerial combat. Your opponents are absolute pros, and every single decision has to be made in a split second. And that fighter-pilot analogy is no joke. When you're scalping, you are literally going head-to-head with some of the smartest, fastest minds in the market. One wrong move, and bam, you're shot right out of the sky. So with that in mind, let's define the rules of this very high-stakes game. At its core, scalping is all about pure, unadulterated speed. You're not trying to hit a home run. Not even close. You're trying to grab these tiny little profits. We're talking just cents at a time, but you're doing it over and over again. The whole mission is get in, secure that tiny profit, and get out before the market even knew you were there. But before we get into the tactics and the cool technology, we have to understand the pilot. Because in this game, it's not the plane that matters most. It's your mindset. Your psychology is your ultimate weapon. So you gotta ask yourself this. And be honest. This is not for everybody. It takes a very specific and, frankly, a very rare kind of mental toughness. Do you really have it? This right here, this is the DNA of a scalper. You need that razor-sharp focus, that lightning-fast execution speed. But the most important thing on this list? Absolute discipline. There is zero, and I mean zero, room for emotion. Especially hope. Hope is the one thing that will get a pilot shot down, every time. This slide lays out the internal dogfight every single scalper has to win. On the left side, that's your ace pilot. Cool, decisive, disciplined. And on the right, those are the enemies constantly trying to take you down. Greed, fear, and that really dangerous need to be right. You get out when the plan says get out, not when your ego wants to hang on for another second. Oh man, this is one of my favorite lines from the source material, just because it's so honest. Greed is the ultimate enemy. The second you start thinking, oh, just a little more, just one more tick, that's when you're in trouble. That's how a small win turns into a big loss, fast. Secure the profit you planned for and eject. Don't be a pig. Okay, so let's say you've got the mindset dialed in. What does your control panel actually look like? Well, let's step into the cockpit and take a look at the essential instruments a scalper uses to navigate these fast-moving markets. This is your radar. Your heads-up display. It's called a level 2 screen. And what it does is give you this totally transparent view of supply and demand in real time. On the left, you see the armies of buyers and exactly what they're willing to pay. Those are the bids. And on the right, you've got the sellers and their asking prices. This is the battlefield, laid out right in front of you. So, how does the pilot read these instruments? Okay, first, the spread. That's the tiny gap between what buyers are willing to pay and what sellers are asking. It has to be razor thin. A wide spread is just way too risky. Second, you need depth. That means a long line of buyers at that bid price. Think of that as your support, your escape route if you need to sell in a hurry. Without it, you're flying without a parachute. Now, this is a really cool comparison. See, most traders are looking at time-based charts, like the 5-minute chart you see on the left. But scalpers, they often use something called a tick chart. That's on the right. A tick chart completely ignores time. It only prints a new bar after a certain number of trades have happened. So when the action gets hot and heavy, the chart moves fast. When it's quiet, it slows way down. It's a pure momentum gauge. And finally, we've got pivot points. The best way to think about these is as invisible waypoints in the sky. They're these key price levels that are calculated based on the previous day's trading. Floor traders used to use them to make quick decisions on the fly, and they're still incredibly good at showing you where a stock might hit some turbulence or maybe find a strong tailwind. Okay,
We've got the mindset, we've got the tools. Now, let's put it all together and actually fly a mission. We're going to walk through a classic scalping setup, step by step. Let's do this. All right, here's our target. As you can see on the chart, after a really strong push in the morning, the stock has gone quiet. It's just moving sideways in this super tight range. But now, look at the volume bars at the bottom. See how they're starting to pick up? The engine is revving. Pressure is building. Something's about to happen.
So you're in the cockpit. You see this pattern forming on your screen. All the data is telling you a story. What's your decision, pilot? Do you engage? What's the move?
And here's the play. 1. You enter the second it breaks above that tight range, because that huge spike in volume confirms the move has real power behind it. 2. The price climbs. Fast. The momentum is clearly on your side. There's no hesitation. 3. And this is the most critical part. You don't wait for it to top out. You sell while it's still rocketing upwards, right as it gets close to a known resistance level. Get in, get out, mission accomplished.
So what was the reward for that high-speed, high-stakes maneuver? Not dollars per share, cents. Remember, scalping is not about one big score. It's about executing dozens of these small, precise missions perfectly day after day, and letting all those small profits build up into something really significant.
All right, let's bring it in for a landing and debrief the mission. We've seen the intensity, we've seen the mindset, and we've seen the execution it requires. So what are the key takeaways here?
This right here is your final pre-flight checklist. Before you even think about putting on a trade, every single one of these conditions has to be green. Is the overall market flying in your direction? Is the sky clear of any immediate resistance? Is the pattern clean? Do you have strong volume? And, most critically, does your radar, the level 2, show a tight spread and good depth? If you get a no on even one of these, the mission is a scrub. You just don't fly. And look, if you remember nothing else from this, please remember this. Ego has no place in the cockpit. The goal is never to be right. It's to be profitable. Scalping is about capturing a very brief burst of momentum. Your job is to grab a piece of that move and then exit while the buying is still frantic. You get out when you can, not when you're forced to. So we've flown inside the world of trading's fighter pilots. It is a discipline of extreme focus, incredible speed, and just iron-willed emotional control. And it is absolutely not for everyone. So the final question is, after seeing what it truly takes, are you built to be the pilot? Love your losses. I know, it sounds completely insane, right? But what if I told you that the real secret to a long, successful trading career isn't your wins at all, but how you deal with your losses? We're going to dig into why learning to embrace your losses is maybe the most powerful thing you can ever do. And this, right here, is the heart of it. It's a total mindset shift. The idea is that mastering your losses, not just chasing those big wins, is the true path to actually lasting in this game. So, okay, how do you actually manage and learn from those losses that are, bound to happen? It's not some kind of magic trick. It all starts with one simple but totally essential tool, the success journal. And let's be really, really clear about this from the get-go. The goal here is not to beat yourself up over your mistakes. We are reframing this whole thing. This is about creating a forward-looking playbook for getting better, and it's built on cold, hard data from your own trading. Now, what's so brilliant about this is the structure. It's a simple 3-step process that takes a loss from this big emotional thing and turns it into an actual actionable plan. Step 1, it forces you to look at your original logic. Step 2 makes you state the facts, just the facts of why you lost, no emotion involved. And then step 3, which is the most important one, it forces you to create a solid rule for the future. And hey, it's not just about the losses either. You've got to write down your wins and figure out why they worked so you can do it again. And then reviewing this thing every single day helps burn those lessons into your brain. And get this isn't just some nice idea. It's a habit of the most successful, wealthiest traders out there. All right, so once you start journaling, you're going to start seeing patterns. And a lot of these patterns are super common, self-destructive habits. Let's call them trading sins that can turn a perfectly good trade into a really bad loss. The author is super clear that they have personally lived through every single one of these painful moments. So the whole point here is for us to learn from their mistakes, so we don't have to learn these lessons the hard way. Ah, the classic roller coaster. A trade is going your way, you're feeling great, but instead of taking that profit, you get swept up in the dream of what it could do. Greed kicks in and you ride that winner all the way up and then all the way back down into a loser. The only cure for that? Discipline. You have to have a plan and just stick to it. Oh boy, this is where ego just destroys accounts. Your quick scalp trade goes against you. But instead of taking that small planned loss, your brain goes, oh, no, it's a day trade now. Then it keeps going down, and suddenly it's a swing trade. You see how this happens? A tiny, manageable loss just snowballs into a disaster, all because your ego couldn't just admit it was wrong. Come on, we've all felt this one. The market's dead, you're bored, and you see a stock that's just getting crushed, and you think, I'm going to be a hero and catch the exact bottom. Well, that's called trying to catch a falling knife, and you usually just get hurt. Just remember this. When you're building your portfolio, you want the strongest players on your team, not the ones with broken arms. So what's really fascinating here is that all of these painful situations, the roller coaster, dropping your stop, the falling knife, almost all of them, and so many others, are caused by ignoring one simple, fundamental thing. Seriously, think about it for a second. If you could do just one thing to prevent all that pain, that pit in your stomach and the financial hit, what would that one thing be? That's it. It is literally that simple. The solution is staring you in the face on every single trade you make. Now, following it, well, that's the hard part, but it is the key that unlocks absolutely everything else. This is the oath that every trader needs to take. Seriously, print it out, tape it to your monitor, whatever you got to do. This promise is your #1 defense, not against the market, but against your own worst emotional impulses. Okay, so let's get to the final piece of the puzzle, because honoring your stop, avoiding all those deadly sins, at the end of the day, it's a psychological battle. It's a battle with one really powerful, really primal emotion. And that very first step on the journey to becoming a disciplined trader is understanding the nature of the thing that makes us break all our rules in the first place: fear. You see, we have to completely reframe how we think about fear. It's not the enemy, it's just a biological warning system. It's a signal that's trying to keep you safe. The problem isn't the signal itself. The problem is when we mistake that signal for the absolute truth and let it grab the steering wheel. So how do you handle it? Well, there's a 3-step process. First, you just acknowledge it. No judgment. Okay, I'm feeling scared right now. Simple. Second, you comfort that feeling like you would a scared kid. Hey, it's okay to feel this way. And then third, once it's calmed down, you gently replace it with its opposite: feelings of safety and security. I've got a plan. I'm going to stick to my plan. And that's really the ultimate takeaway, isn't it? When you learn to listen to the warning without being controlled by the emotion, that's when you can finally separate your decisions from your fears. You can honor your stops, you can avoid the sins, and you can finally start trading to trade well, not just to make money. So what is your fear really trying to tell you today? So what's the real difference between a professional trader and, well, everyone else? It's not some secret code or a magic algorithm. It really comes down to a way of thinking. And today, we're going to crack open that playbook and see what's inside. And the way we're going to do this is by looking at some fantastic advice from author Toni Turner. And I love how she puts it. She says this is the kind of stuff she'd tell you if you just called her up on the phone, as friends, as fellow traders. It's that kind of practical, real-world insight. All right, so here's the plan. First, we'll get into that professional's mindset. Then we'll talk about reading the big picture of the market. After that, we'll decode some of the market's key storytellers. And finally, we'll wrap it all up with the discipline rules that every pro lives by. Okay, first up, the professional's mindset. This is probably the biggest leap you can make as a trader, getting out of that reactive, emotional headspace and into a more reasoned, logical one. So, what's at the core of this pro mindset? It's something called the if-then mentality. And really, it's just a structured way of thinking. It's about moving away from wild guesses and gut feelings and instead thinking in terms of cause and effect. Action equals reaction, right? So if something happens in the market, then a probable reaction will follow. It's all about connecting the dots. Here's a classic example. If the Asian exchanges sell off overnight, right? You wake up, you see that. Then you can bet that the US markets might feel some of that negative pressure at the open. See? It's not a crystal ball, but it's a logical connection that helps you anticipate what might be coming instead of just reacting to it. Okay, so we've got that if-then logic for specific events. Now let's apply that thinking to the bigger picture, to the overall rhythm of the market. And this is a really big one. Cycle tops are always high-risk periods. Trying to fight the major trend of the market, it's like trying to swim upstream in a powerful river. You might make a little progress, but eventually the current's going to win. Even if you're just in it for the short term, ignoring the big trend is, well, it's a recipe for disaster.
And this visual illustrates that perfectly. You can literally see the rhythm of the market here, these high-risk zones up near the peaks, and the lower risk, or maybe I should say higher opportunity zones, down near the bottoms. Pros aren't trying to guess the exact top or bottom, they're identifying these zones to manage their risk. Now here's a crucial point. Look at both of these transition zones, the tops and the bottoms. They're both described as whippy and choppy. Why? Because in those areas, the market has no clear direction. It's like a tug of war between the buyers and the sellers, and nobody's winning yet. That creates a ton of false signals and erratic moves, which can just chew up short-term traders. So let's bring our if-then logic back into the picture. If the market is in one of these high or low risk transition zones, then trading conditions are going to be choppy and unpredictable. And what does that mean for us? It means it's time to be patient. Maybe build up some cash, sit on the sidelines, and just wait for a clearer trend to emerge. All right, so we're getting a feel for the big picture. Now let's look at a couple of tools that help us see what's really going on underneath the surface, kind of like lifting the hood on a car to check the engine's health. First up is the Advanced Decline Line, or AD line. Think of this as the market's head count. It's super simple. It just compares the number of stocks going up versus the number of stocks going down. This tells you if a rally has broad support, like an army advancing together, or if it's just a few big generals leading the charge while the rest of the troops are actually retreating. And this leads to a classic if-then warning sign. If the Dow, or the S&P 500, is making new highs, but the AD line is failing to do the same, then the market might be in trouble. This is called a divergence, and it's a huge red flag. It's telling you that the foundation of the rally is getting weaker, even if the headline number looks good. Okay, storyteller number 2 is the Treasury bond market. You gotta watch the bonds. Why? Because bond traders are some of the first to react to any big economic news. I mean, they react instantly. And very often, the way the bond market moves gives you a sneak peek at how the stock market is going to react a few minutes or even hours later. And speaking of those connections, here are a few more really solid if-then relationships that the pros keep on their radar. You know, if oil prices spike, then you'd expect transportation stocks to take a hit. If there are signs of inflation, then gold and silver might get a boost. These aren't ironclad laws, of course, but they are reliable patterns that can give you a real edge. Okay, let's shift gears a little and talk about market psychology. The author has a great name for this. She calls it the too much chocolate problem. You know that feeling, right? When something is so good, but you have way too much of it and you start to feel sick? Well, the same thing can happen in the market with optimism. This gets us to the idea of being a contrarian, of using what are called contrarian indicators. The basic idea is this. When almost everybody agrees on something in the market, like it's definitely going up from here, that's often the exact moment it's about to do the opposite. It's like everyone has run to one side of the boat and it's just about to tip over. So take a look at something like the Advisor's Sentiment Report. Let's say it shows that 55% of financial advisors are bullish. Now, on the surface, that sounds great, right? The experts are feeling good, so maybe we should too. But from a contrarian point of view, that's actually a bearish signal. Why? Well, think about it. If all the optimists and all the people who wanted to buy have already bought, who's left to keep pushing prices higher? When optimism gets that extreme, it usually means the market is getting top-heavy and is vulnerable to a fall. Okay, so we've talked about mindset, market cycles, and key indicators. But honestly, none of that matters without discipline. You can have the best tools in the world, but if you don't use them consistently, they're worthless. Which brings us to our final and maybe most important section, the rules. A lot of professional traders will literally print out a list of rules like this and tape it to their monitor. Think of it as your conscience, right there on the screen. These aren't just vague ideas, they're non-negotiable commands. And just look at number 2, trade to trade well, not to make money. That one is huge. It shifts your focus from the chaotic outcome, the money, to the one thing you can actually control, your process. And that really brings us full circle, doesn't it? In the end, trading isn't really a game of numbers or charts. It's a mental game. It's all about what's going on between your ears. I love this quote. All that we are is a result of what we have thought. What we think, we become. So if there's one thing to take away from all this, it's that successful trading isn't some magical act of predicting the future. It's about conscious thought. It's about building a logical, disciplined process that, over time, puts the probabilities on your side. The real question is, what will you choose to think? Thanks for joining us for this explainer.
We'll see you next time.
Day trading. You hear about the excitement, the freedom, the profits. But for most beginners, what you actually get is one thing above all else: overwhelm. So in this explainer, we're going to dig into Toni Turner's classic guide to help cut through all that chaos and find a clear path from information overload to trading with confidence.
So if you're new to trading, does this feel a little familiar? I bet it does. It's that feeling like you're just drowning in a tidal wave of market data, breaking news, and a million so-called expert opinions. It's enough to paralyze you before you even place your first trade.
Okay, the first thing you really need to understand is that this feeling, this state of overwhelm, is completely normal. I promise, it's not just you. Even seasoned pros get swamped by the sheer, gargantuan size of the financial markets. It is not a sign of failure. Actually, it's a sign that you're paying attention.
And this brings us to the single most important realization for any new trader. You cannot possibly know everything. You just can't. Trying to is a guaranteed path to burnout. So the goal isn't to absorb more information. The goal is to get a whole lot smarter about how you filter it.
So how do we fight back against the chaos? Well, the answer is surprisingly simple: specialization. This is the single most effective strategy to gain control, focus your energy, and finally start making some real progress. Think about it like this. On one side, you have the generalist trader. They're kind of like a family doctor. They know a little bit about a lot of things. But on the other side, you have the specialist. This is your heart surgeon. By mastering one specific area, they achieve a level of expertise and success that the generalists simply can't match.
So what does this specialization actually look like? Well, you don't trade the entire market. You pick a corner. Maybe you're drawn to the volatility of tech stocks, or maybe you prefer the stability of large-cap ETFs. The goal is to find your niche and own it. Okay, so once you've started thinking about your niche, you need the right tools. And let's be real, the internet is a double-edged sword. It's full of incredible information, but also a ton of noise. So let's look at a few high-caliber resources to get you started on the right foot.
First things first, you need your daily briefing on the market's health. Sites like the Wall Street Journal and Yahoo Finance give you that essential, reliable news and data that forms the backdrop for any trading decision. Think of this as your non-negotiable homework.
But news only tells you what is happening. To understand how the market is reacting, you need to analyze price action. That's where charting tools like StockCharts.com come in. This is Technical Analysis 101, using charts to spot patterns and bring your trading strategy to life.
Now, once you have your data and your charts, there's another resource many traders turn to for ideas and community: online chat rooms. And this is where things get really tricky. They can be a source of connection, but they also come with a big flashing warning label.
Honestly, you should treat online chat rooms like a minefield. Before you join any community, investigate it. Be really skeptical of any self-proclaimed gurus. And here's the golden rule: never, ever take a stock tip at face value. Always run it through your own analysis first. You know, this all comes down to one core idea. Your goal is to be proactive, making trades based on your own well-researched plan. You don't want to be reactive, just chasing after hyped-up stocks you heard about in a chat room. That's how you lose money. And speaking of losing money, let's switch gears and talk about some serious traps you need to avoid. Protecting your capital is your #1 job as a trader, and these are two of the biggest threats out there. First up is the classic pump and dump. This is an outright scam, and it's most common with very small, low-volume stocks. A so-called guru will hype a stock to their followers to artificially inflate the price, only to sell their own shares to those same followers for a quick profit. Here's exactly how the scam works, step by step. First is the bait. The guru secretly buys a ton of a cheap stock. Then comes the pump. They blast out an urgent, "Buy now, it's going to fly" tip. Next, the spike. Their followers pile in, which artificially inflates the price. And finally, the dump. The guru sells all their shares to those same followers, leaving them holding the bag as the stock crashes.
The second major trap is the world of fraudulent get-rich-quick trading courses. Now, there are many legitimate educators out there, but there are also predators who promise unrealistic returns when their real business is earning commissions when you open a brokerage account through them.
This quote from the source perfectly captures the red flag. If you hear anyone downplaying the need for actual education while promising huge returns like this, run. As the author says, their promise is baloney, double baloney.
And to put those wild claims into perspective, here's a dose of reality for you. Experienced professional traders are extremely happy to earn 40% on their account in an entire year. Anyone promising you multiples of that is just not being honest.
So how can you spot the difference? Well, look at the instructors. Are they real traders or just wannabes? Look at the content. Does it teach a real methodology or just a superficial system? And look at the focus. Is it on your education or is it on getting you to open a brokerage account?
All right, after all those warnings, let's end on a positive and empowering note. Avoiding the traps is half the battle. The other half is actively building the foundations for a long and successful trading career.
These are the pillars of success. Knowledge is number one. As the author says, you can go to school or you can let the market teach you through expensive losses. School is cheaper. Discipline is about applying that knowledge when the pressure is on. Independent thinking protects you from those scams. And finally, persistence. That quality, along with courage, is what ultimately molds an excellent trader.
And so we end right where we began, but with clarity instead of overwhelm. The goal isn't to know everything, it's to master one thing. So the only question left is the one you see right here. What corner of the market will you master?